Hey, how's it going? Today I'm going to be talking about dividend discount model and what that is. Dividend discount model (DDM) is method used in or by investors to estimate the intrinsic value of stock by analyzing its future dividend payments. It is based on the premises that the value of the stock is determined by the present value of all expected future dividends. The DDM is particularly useful for valuing stock of companies that pay regular dividends. As you probably know, not all companies pay those. For those of you who would like to understand a little bit better of overall process or how to begin or start investing into different businesses, I highly recommend you delve into its murky waters and try to learn as much as you can. Some of the companies do pay those, and some of the companies pay very large dividends. You might consider investing some portion of your overall portfolio or begin investing in those companies and start or begin understanding the process of how to do it and how this process can work. Before you do that, perhaps it's worth noting that I'm not a financial advisor and this video is just for entertainment and education purposes only. There are two main variations of dividend discount models. First one, Gordon Ground model, single stage DDM, and there's gonna be different stages, right? So this one is a single stage. This model assumes that dividends will grow at a constant rate indefinitely. It's also known as the Gordon Ground model or the Perpetuity Model. The formula for a Gordon Ground model is PO equals D1. I don't want to get anyone confused. I will skip that. But if you are interested, perhaps it's worth taking a look at. I don't know if it's accurate. The model is there that it assumes what future gonna be like based on perhaps what current value, or perhaps past, or what's very hard for me to be on board when someone says that our future is going to be the same as it was in the past based on the particular companies. And most of the companies, they can run the particular operations depending on the sector for 8 years, 12 years, 20 years perhaps. So I don't know how accurate that is and for what kind of business models those formulas can be used for, but either way. In this model, the key is estimate the reasonable growth rate and the required rate of return. If the growth rate is greater than the required rate of return, the formula doesn't work because it implies infinite value. This is unrealistic. This model is approached for mature companies with established dividend growth. I mean, yeah, like I mentioned, so it's not as you probably there's a lot of balancing act going on, right? So the people out there who have done their own research, they do understand the markets and they do understand different, perhaps, companies out there. There's a more to it, not necessarily limited to just to this particular formula. Just understanding this, perhaps it's worth mentioning for you out there. Let's take a look at the next stage. That would be multistage DDM, two-stage or three-stage DDM, right? This model is used when a company dividend growth rate is expected to change over time. This is so far it sounds more likely. This is what's gonna happen, right? With market fluctuations, you name it, right? Perhaps history is good projection measure, but is it? Can you really predict the future, right? I don't know. I don't know. Maybe there are some people out there with a crystal ball, but either way, it uh, dividends the analyzes into two or more stages, each with its own growth rate. For example, a company might experience higher growth in its early years and settle into a more stable growth rate. The formula for two-stage DDM looks more like PO equals to DM. Either way, either way, let's summarize everything. This model requires estimated different growth rates and discounting rates for each stage of the company's life cycle. It's important to note that the accuracy of DDM relies heavily on accuracy of the assumption. Exactly, exactly. There's a lot of assumptions over here going on. So I don't know if it's accurate. I'm just overview the formula. It's all what I'm doing when making your business decisions or making sound decisions when it comes to perhaps predicting markets. It's the only thing where I can believe it. All these formulas can be only assumption, right? Especially for growth rate and discount rate. Small changes in these values can lead to significant differences in calculating intrinsic value. Additionally, DDMs may not be suitable for companies that do not pay dividends or have erratic dividend patterns. In such cases, other value methods like price earnings ratio or discounted cash flow (DCF) analysis might be more appropriate. For those of you up there who would like to learn more or perhaps improve your, at least that's how I understand it. I have published a journal, and the reason why I did it is to improve my own time management. I broke 24 hours or day cycle into 24 hours, and I was looking to optimize those 24 hours and how I could do it. Identifying 24 hours and making most of those 24 hours, that was the way how I did it. And I have identified areas, particular areas, which I personally believe are important to focus on every single day. Keeping track of time and management of time. This is what is based on, as well as structuring, so you can develop a habit. So that means whatever you do might last over a certain period of time, hopefully many years, right? You can find this journal in the description below, as well as Top Retailers has it. I'll try to take an example and do one example. Hopefully everyone will understand in 3 minutes if I can. The dividend discount model (DDM) is important because it provides a systematic and theoretically sound approach to valuable stocks, which can be valuable for investors and financial analysts. Let's take a look at why it can be important. Example: imagine you are an investor interested in purchasing shares of two different companies, Company A and Company B, which are in the same industry and have similar financial portfolio. Both of companies are expected to generate constant and growing cash flow over time. So those companies are growing, right? Company A pays regular dividends for its shareholders, and Company B does not pay dividends, and it instead reinvests all the earnings back into business growing, into the business to just keep on growing, right? So instead of paying out, one company instead of would focus on paying, another company reinvest back into the company. That they have two different strategies, right? So we don't have a lot of time. Company A, with the company A, you can use dividend discount model to estimate the company's intrinsic value to its stock based to its expected future dividend payments. DDM helps you to determine how much of the company's stock is worth today, taking into account the expected cash flow in the form of dividends. It allows you to compare the calculation intrinsic value with the current market price in the stock. If the intrinsic value is higher than the market price, it may indicate that the stock is undervalued and potentially good investment opportunity. That's Company A, and the Company A regularly pays dividends to its shareholders. Company B. Company B did not pay dividends. For Company B, since it doesn't pay dividends, you cannot use the DDM directly to value its stock. DDM relies on expected dividend payments as a key input. Instead, you may be needed to use alternative value methods like discounted cash flow, DCF, analyzing or price to earnings ratio to estimate the intrinsic value of a company's stock. What you are looking to do is determine what's the value of the company. This method takes into account the expected cash future cash flow generated by the companies, but don't that do not rely on dividend payments as primary source of value. Just how you can value a company based on future potential earnings or dividend payments, right? Importance of DDM. The DDM is crucial when evaluating stock of companies that pay dividends because it provides a clear framework for assessing their intrinsic value based on expected future dividends. It helps investors make informed decisions about whether the dividend paying stock is overvalued, undervalued, or fairly priced. DDM also highlights the importance of dividends as a source of returns for investors who rely on income from their investments, such as retirees. Either way, just to summarize, hopefully you find some value in this video. Thanks for watching, and I'll see you in the next one.